So imagine you've just come into a really nice chunk of money.
Oh, that is always a fun scenario to picture.
Right. Like maybe you sold a small business or received an inheritance, or you just finally saved up a significant amount, let's say right around $10,000.
Okay, 10 grand. A
No.
solid amount of cash.
Yeah. And you know you need to invest it. But as you're just standing there with the funds sitting in your checking account, you face, honestly, one of the most agonizing decisions in personal finance.
It really is. It's the classic dilemma. Do you plunge it all into the market at once?
Exactly. Lump sum investing.
Right. Or do you wade in slowly, investing a little bit at a time using dollar cost averaging?
Yeah, and to figure out which strategy actually works best, we're doing a deep dive today into a massive stack of sources. I'm talking decades of historical market data from Vanguard and Morgan Stanley.
Plus some really fascinating behavioral psychology papers.
Yeah, and even some pretty dense academic mathematical models, because our mission today is to just cut through the conventional wisdom and look at the actual mechanics of what happens to your money.
And what makes this specific decision so paralyzing for people is that, well, both sides actually have highly compelling arguments.
They really do. Whenever I think about this debate, I picture this split screen in my head. On one side, you've got the cold, hard mathematics of the market,
Like a chaotic stock ticker flashing red and green.
totally indifferent to how you feel. And then on the other side, you have a perfectly calm, serene Zen garden. And that represents our psychology, our need to just sleep at night.
That dichotomy is exactly why this debate has raged for decades. I mean, the stock ticker points in one very clear mathematical direction, while the Zen garden points in another.
It kind of feels like standing at the edge of a really cold pool. Like, do you cannonball in all at once, get the shock over with, and just start swimming? Or do you take it step by step?
Wading in up to the ankles, then the knees.
Right, getting used to the temperature slowly. But, here's my pushback right out of the gate. Why is this even a debate at all?
What do you mean?
Well, if we look at the broad history of the stock market, it trends upward over the long term.
Right. Generally speaking, yes, absolutely.
So if the overarching trajectory is up, shouldn't you just put your money in as fast as humanly possible to capture that upward drift?
I mean, that is the logical assumption.
Yeah.
And it is grounded in reality.
Mhm.
But before we declare a mathematical winner and tell everyone to just, cannonball into the deep end, we have to look closely at the mechanics of dollar cost averaging.
Or DCA, as we'll probably call it.
Exactly, DCA. Because we need to understand exactly why it looks so incredibly attractive on paper, especially during times of high volatility. Fun fact, the term was actually coined by Benjamin Graham back in 1949.
Oh, in The Intelligent Investor.
Yep, exactly.
Okay, let's unpack this, because I know the theoretical appeal of DCA relies really heavily on the concept of buying the dip automatically.
It does. Let's walk through the mechanics using a specific scenario from the RL360 analysis we looked at.
Okay, lay it on me.
Imagine you decide to invest your money over the course of a year. You commit to, say, $750 a month.
Right, so over 12 months, that totals $9,000, which scales perfectly with our $10,000 target scenario for you listening.
Exactly. So let's look at how the math plays out in a highly volatile year. You start buying in month one when the unit price of the asset is exactly $1.
Okay, so my $750 buys me 750 units.
Right. But then the market tanks. Over the next few months, the price drops down to 80 cents, then 60 cents, all the way down to a low of 50 cents.
Oh man, so your portfolio just looks like it's bleeding out on paper?
It definitely does.
Yeah.
But mechanically, your fixed $750 is now working much, much harder.
Oh, because the price is cheaper.
Right. At 50 cents a unit, your monthly contribution is suddenly buying 1,500 units instead of 750.
Wow, okay. So you're naturally acquiring way more shares when the asset is cheap.
Precisely. Now, let's say the market eventually recovers, and by month 12, the price has actually climbed to $1.20.
So by steadily buying every single month with that fixed amount, I've drastically lowered my average cost per unit.
You have. And by the end of those 12 months, because you accumulated so many units at the bottom of that dip, your initial $9,000 has grown to $13,843.
Okay, that is a nice return.
Now, compare that to the cannonball approach. If you had taken that same $9,000 and invested it all as a lump sum at the very beginning of the year.
When the price was $1.
Exactly. If you just bought at $1 and held it, your final value at the $1.20 mark would only be $10,800.
Wait, So by waiting in slowly, you'd generated over $3,000 in additional wealth.
Yeah, the math is pretty striking.
Okay, wait, I see a massive structural vulnerability here, though.
Let's hear it.
This example relies entirely on the market tanking right after you buy your first batch. Like, it completely requires a severe, prolonged dip to work.
You are absolutely right.
But what if the market just goes steadily up? I mean, if the price goes from $1 to $1.10 to $1.20 over the year, wouldn't DCA force your cash to just sit on the sidelines?
Yes, it would.
You'd completely miss out on all that early compounding growth.
What's fascinating here is that you've just identified the exact mathematical flaw of dollar cost averaging.
Uh-huh.
The mechanism of lowering your average cost only triggers if prices fluctuate downward during your specific accumulation period.
Right.
If prices rise, which, as you noted earlier, is the historical norm for equities, holding cash back simply acts as a massive drag on your overall return.
Because as the price climbs month after month, my fixed $750 is buying fewer and fewer shares.
Exactly.
So the RL360 example is essentially like a perfectly timed hypothetical. It works beautifully if you happen to start investing right before a major correction.
Which is very hard to predict.
Exactly. It falls completely apart in a sustained bull market. And since we know we can't reliably predict corrections, we have to look at what happens in the real world over decades of actual market history.
Right, we have to look at the big data.
So what do the massive historical analyses actually tell us?
Well, the historical data is remarkably consistent and, frankly, quite brutal for dollar cost averaging.
Oh, really? Let's talk about the Vanguard analysis first.
Yeah, Vanguard ran a massive comprehensive analysis. They examined rolling 10-year periods in the US, the UK, and Australia, spanning from 1926 all the way to 2011.
Wow, so that's testing almost a century of market environments.
Right. They modeled a balanced portfolio, 60% stocks and 40% bonds, and they tested every single possible entry point.
So testing every entry point means they captured the Great Depression, the dot-com bubble, the 2008 financial crisis.
And all the massive bull runs in between.
Okay, so what were the actual results?
Across all three global markets, lump sum investing outperformed a 12-month dollar cost averaging strategy roughly 67% of the time.
Wait, 67%.
Yeah. Two-thirds of the time, plunging your money in all at once resulted in higher terminal wealth at the end of 10 years.
That is a dominant, undeniable win rate. I mean, do we have a sense of the actual wealth difference? Are we talking about a few pennies or like a significant gap?
Oh, it's significant. On average, a lump sum approach in the U.S. left investors with 2.3% more ending wealth compared to the DCA strategy.
Wow. And this isn't just an anomaly in Vanguard's methodology, right? Because I know we looked at another study.
Right. The Morgan Stanley analysis corroborates this entirely. They looked at a slightly different time frame. Over 1,000 rolling 7-year periods from 1926 all the way through 2023.
So even more recent data.
Yep. And they found that lump sum investing beats a 3 to 12-month DCA strategy between 56 and 65% of the time.
So no matter how you slice the time frames, the cannonball method wins roughly 2 out of every 3 times.
It does.
Let's dig into the mechanism behind why it's so consistent. I mean, is it purely just the upward drift of the market?
It really comes down to a fundamental economic engine called the risk premium.
The risk premium. Okay, explain that.
So stocks and bonds inherently carry a risk premium, which means investors are mathematically compensated for taking on volatility. Over the long run, these assets must return more than holding risk-free cash.
Right. Otherwise, capital markets would literally cease to function. Nobody would invest.
Exactly. When you use dollar cost averaging, you are intentionally holding a large portion of your $10,000 in cash, earning essentially zero risk premium, while you just wait for the calendar to tell you it's time to invest.
That makes total sense.
Vanguard actually frames this in a very stark way. They state that DCA is effectively just a form of market timing. They literally call it taking risk later.
Taking risk later. Well, so holding back your cash is like benching your star player for the first quarter of the championship game just in case they get injured.
That is a great way to look at it.
Like, sure, they're perfectly safe sitting on the bench, but you are completely missing out on all their scoring potential.
Exactly. And in a game where the score generally goes up over time, you need your highest scoring assets on the field from minute one.
That analogy perfectly captures the opportunity cost. Every day your capital sits in cash, it is failing to capture the risk premium it was designed to earn.
The math undeniably favors keeping your star player on the court.
Okay, but here is the massive contradiction, though.
Let's hear it.
If the data proves that lump sum investing wins two-thirds of the time, and we mathematically know that holding cash drags down returns,
Right.
why do so many highly educated financial advisors and, so many families sitting on the sale of a business still religiously use dollar cost averaging? Like, why isn't everyone just doing the cannonball?
It's the multi-million-dollar question. And to answer it, we have to transition away from the stock ticker and walk straight into that Zen garden you mentioned earlier.
Ah, the psychology.
Exactly. We have to look at behavioral finance. Because humans are not perfectly rational calculating machines that simply optimize for expected value.
Cheat for yourself. No, I'm kidding. We are definitely deeply emotional creatures.
We really are. And in the behavioral finance literature, this contradiction is explained by prospect theory, which was pioneered by Daniel Kahneman and Amos Tversky.
The psychological reality of how we process risk and reward. Let's break down how prospect theory applies to that $10,000 check sitting in our checking account.
So the foundational pillar of prospect theory is called loss aversion. Through empirical testing, Kahneman and Tversky proved that humans feel the pain of a loss roughly twice as intensely as we feel the joy of an equivalent gain.
Wait, twice as intensely?
Yes, the psychological devastation of losing $1,000 is literally twice as powerful as the dopamine hit of gaining $1,000.
Wow. Which completely explains the hesitation at the edge of the pool.
Exactly.
Because if I invest my $10,000 today and tomorrow the market drops 10%, the fact that the math says it will likely recover in a few years doesn't matter to my nervous system at all.
It doesn't. Your brain is sounding the alarm.
Yeah, that immediate visceral pain of seeing the balance drop to $9,000 is just overwhelming.
It is overwhelming, and it completely overrides mathematical logic. There's actually a famous story in the Archbridge analysis we read that illustrates just how deeply ingrained this is.
Oh, the coin flip story.
Yes, even in experts. So the Nobel Prize-winning economist Paul Samuelson once offered a colleague a really simple coin flip bet.
Okay.
If the coin lands on heads, the colleague wins $100. But if it lands on tails, the colleague loses $50.
Wait, if we just look at the expected value of that bet, it's massively in your favor.
Massively.
You have a 50% chance to win 100 and only a 50% chance to lose 50.
Yeah.
I mean, any purely rational actor takes that bet every single time.
They absolutely should. The mathematics are undeniably favorable. But Samuelson's colleague, who was a highly educated academic, by the way, he completely refused the bet.
Unbelievable.
He explicitly stated that the emotional pain of potentially losing $50 would outweigh the joy of winning $100.
That is just loss aversion overriding mathematical optimization in real time. It's crazy.
It is, but there's actually a second psychological layer here that the Morgan Stanley report emphasizes. It's called regret aversion.
Regret aversion. How does that differ from basic loss aversion? Is it more about like personal culpability?
Precisely. It is entirely about the burden of agency. Think about it. If you take your $10,000, execute a lump sum trade on a Tuesday, and the market crashes on Wednesday.
I feel entirely responsible.
Yes. You click the button. You made the active choice that destroyed that wealth.
Oh, wow.
But dollar cost averaging acts as a psychological buffer against that exact type of regret. By relying on a slow, automated, predetermined schedule, you kind of diffuse your sense of personal responsibility for any immediate downward volatility.
Here's where it gets really interesting for you listening. So DCA isn't really a wealth maximizing strategy at all. It's an emotional insurance policy.
That is the perfect way to phrase it.
You are looking at the data, you're seeing that lump sum wins two-thirds of the time, and you're actively choosing the lower probability of success in exchange for peace of mind.
Right. You're paying a premium, essentially.
Yeah, in the form of missed compounding growth, just to ensure you don't panic and liquidate your portfolio at the absolute bottom.
You are paying a psychological tax.
Yeah.
And for many people, especially those who know their own risk tolerance and know they might abandon their long-term plan, if they see red numbers on day one, the tax is an absolute bargain.
So in the traditional narrative, the story usually ends right here, right? Math beats emotion on a spreadsheet, but emotion dictates actual human behavior.
So you should just do whatever prevents you from panic selling.
Exactly. But looking at our academic sources, some researchers have actually built mathematical models that challenge this entire lump sum supremacy narrative.
Yes, and this is where the academic research moves beyond broad historical averages and looks at the granular mechanics of market pricing.
Let's talk about the paper from Thomas O'Brien at the University of Connecticut.
O'Brien's work is fascinating. He challenges the strict interpretation of the random walk theory.
Remind us what that is.
The idea that stock prices move completely unpredictably from day to day. O'Brien focuses on the fact that equity prices frequently exhibit short-term momentum and long-term mean reversion.
Let's dig into the mechanics of that. What exactly is driving that short-term momentum and long-term reversion?
Well, it's driven by the exact human panic we were just discussing. When bad news hits, human investors overreact. They panic sell, which creates downward momentum.
Right, which temporarily drives the price of an asset below its actual intrinsic value. It gets mispriced.
Exactly. But over the long term, rational capital recognizes the discount, steps in to buy, and the price reverts back to its true mean.
So O'Brien's models demonstrate that because of these transient, panic-driven mispricings, a DCA strategy can actually be mathematically superior to lump sum investing during highly volatile periods.
Yes, because it forces you to keep buying while the asset is artificially depressed.
Okay, but standard DCA is entirely blind. I mean,
No.
it invests the exact same amount on the exact same day of the month, regardless of whether the asset is mispriced or not.
Right. It doesn't care what the market is doing.
So how do you actually capture that mathematical advantage practically?
If we connect this to the practical application, we have to look at the research by Denham and Friesen. They developed a model called Enhanced Dollar Cost Averaging, or EDCA.
EDCA, okay, I like where this is going.
They recognized exactly what you just pointed out. Traditional DCA ignores new information. So they changed the algorithm. Enhanced DCA actively adjusts your contribution based on immediate market conditions.
Okay, how does the EDCA algorithm actually function? Like, what is the rule set?
The rule is elegant in its simplicity, really. If the market experiences a down month, you invest a larger portion of your cash reserve in the following month.
Oh, nice.
And if the market has an up month, you restrict your contribution and invest less.
So standard DCA is like a sprinkler system on a dumb timer. It just turns on at 6 a.m. and waters the lawn even while it's pouring rain outside.
Totally unaware of its environment.
Right. But enhanced DCA is like a smart home system connected to a weather station. It reads the environment, market is bleeding, turn the sprinklers on full blast, and buy the dip aggressively.
Exactly.
Market is running hot. Dial it back and conserve cash.
That is precisely how it operates. It mechanizes the age-old advice to buy low. And the mathematical simulations in their paper are just staggering.
What did they find?
When they backtested the EDCA model against traditional DCA, they found that the enhanced reactive strategy outperformed the blind strategy roughly 90% of the time.
90% of the time.
Yes.
Yeah.
Mechanically, buying heavier into those transient mispricings boosted investor returns by 30 to 70 basis points per year.
30 to 70 basis points. So an extra 0.3 to 0.7% annually.
Right.
Which, I mean, that might sound small to a casual observer, but compounded over 20 or 30 years, that is a massive delta in terminal wealth.
It's a huge difference. It allows you to systematically exploit the short-term panic of the broader market without requiring you to predict the exact bottom.
Which we know is completely impossible anyway.
Exactly.
So what does this all mean for you, the listener? We've covered the historical dominance of the lump sum cannonball.
We've covered the behavioral friction of loss aversion.
Right, and the smart sprinkler mechanics of EDCA. How do we synthesize all of this into a framework for the person sitting on that $10,000 check right now?
To synthesize this into an actionable framework, we should look at one final piece of mathematical modeling by Hayden Brown.
Okay, Hayden Brown's lump sum discount, right.
Yes. Brown looked at the precise risk exposure curve of a dollar cost averaging strategy. Think about it. In month 1 of a 12-month DCA, you have very little market exposure and high cash.
Right.
But in month 12, you have high market exposure and zero cash.
Right, so your risk scales up linearly over the year.
Exactly. Brown mathematically proved that you can achieve the exact same terminal wealth distribution and the exact same risk profile by simply bypassing the slow bleed entirely.
Wait, so?
You can replicate the specific risk curve of a 12-month DCA by simply holding your cash for a few months and then investing a slightly larger lump sum for a shorter overall duration in the market.
Wait, let me make sure I understand the mechanics of that. Brown is saying that DCA is so mathematically inefficient at capturing the risk premium that you can literally just shorten the time frame your money is exposed to the market,
Yes.
drop a lump sum in later, and achieve the exact same statistical safety net.
That is exactly what the math dictates. It strips away the illusion that spreading your payments out is some kind of magic shield. The safety of DCA simply comes from having less money in the market for a longer period of time.
That is mind-blowing.
But if we pull all these threads together from Vanguard, Morgan Stanley, Archbridge, and the academic models, the framework becomes very clear.
Okay, let's lay it out.
First, if your sole objective is to maximize your expected terminal wealth, and your nervous system can handle a 10% drop tomorrow without panic selling.
Then the math is unequivocal.
Mm.
Execute the lump sum.
Exactly. Put the 10,000 in immediately and let the risk premium go to work.
Keep the star player on the court for the whole game.
Got it. But what is the protocol for the investor who knows they will absolutely lose sleep if they cannonball in?
If fear of regret or loss aversion is going to paralyze you or cause you to abandon your strategy, dollar cost averaging is a highly rational behavioral tool.
But there's a catch, right? There is. And this is the critical caveat highlighted by the Archbridge analysis. If you choose DCA, you must completely remove human agency from the execution.
Oh, right. You
Ah.
have to set a strict, unchangeable calendar.
Yes. For example, commit to investing 25% of your cash on 4 specific predetermined dates. If you manually log in every month and try to decide if it's a good day to buy,
Your loss aversion will hijack the process.
every time. Yeah. And you will end up trying to time the market, which destroys wealth.
Or, I suppose, if you want to capture some of that transient mispricing without trusting your own emotions, you can automate an enhanced DCA strategy.
Exactly. Program your allocations to increase after a down month and decrease after an up month. If we connect this to the bigger picture, the ultimate takeaway here is that your psychological risk tolerance is just as vital a metric as any historical data point.
Because the mathematically optimal strategy is entirely worthless if your emotional state prevents you from sticking to it during a crisis. So, to summarize our journey today, we started with the agonizing dilemma of how to deploy a $10,000 windfall.
We looked at a century of data.
They discovered that the lump sum cannonball wins the math battle roughly 2/3 of the time by immediately capturing the market's risk premium.
But we also mapped the deep psychological terrain of loss aversion.
Right, discovering that dollar cost averaging, especially its reactive cousin, enhanced DCA, wins the psychological war by shielding us from the paralyzing weight of regret.
It really does. And as we wrap up, there is a fascinating new dynamic to consider that builds on all this behavioral psychology we've been unpacking.
Oh, let's hear it.
Well, we've established that DCA is an emotional insurance policy designed to help you ignore the market and sleep well. Right.
Right.
But think about the modern landscape of zero-commission trading apps. These platforms are explicitly designed to be frictionless, heavily gamified, and constantly sending you push notifications about daily price movements.
Oh, wow. I see where you're going with this.
If you are using DCA to protect your peace of mind, but you are executing it on an app that bombards you with a dopamine hit or a panic trigger every time you open your phone,
Then are you actually buffering your loss aversion? Or are these platforms weaponizing your DCA schedule to keep you hyper-fixated on the very volatility you were trying to ignore?
exactly. It's a provocative thought from the Vanguard analysis. We think of DCA as the safe, passive choice. But by purposely holding cash back and delaying your investment, you are making an active bet that the market will drop. Think about it. Is your desire to feel safe unintentionally turning you into a market timer?
That is a phenomenal point. By making the execution of the strategy so interactive and omnipresent, the technology might be completely neutralizing the psychological peace of mind that DCA was built to provide in the first place.
It is definitely something to evaluate when setting up your own systems.
Absolutely. Well, thank you for joining us on this deep dive as we unpack the data, the math, and the deeply human psychology behind this decision.
It was a great discussion.
And remember, while this isn't financial advice, you are now armed with the structural mechanics to understand exactly what your money is doing. So examine your own risk tolerance, check the temperature of the water, and decide for yourself. Are you going to wade in slowly, or are you ready to cannonball?